everybody. My name is Mathew Owens, and welcome to the Masters of Real Estate. Today, I'm going to talk to you about why you should never be paying taxes on your rental income or other passive income ever again. So there's some really cool, awesome strategies that you can use to wipe out taxes. And of course, I'm over here in sunny Southern California right now, and of course, one of the heaviest tax states there are. And so I do a ton of different planning to try to mitigate my own tax burden and some of my investors, and show them the strategies that I use to mitigate taxes and help to, lower that burden to become a better investor and a smarter investor with my capital. So at the end of this video, I'm going to share with you one of the key strategies I use to literally never pay taxes on my rental income or my passive income ever again. So obviously there's some great strategies that you can utilize, and a lot of people utilize to mitigate taxes in a lot of different ways. There's some traditional ways and not so traditional ways to be able to mitigate that burden and not pay, the taxes that are, of course, theft out there from the government, in my eyes at least. So one of the biggest things you can do, of course, is 401k contributions. But did you know, if you are self-employed without any full-time employees or without any employees, and you're working for yourself, not only can you set up an S corporation and start your own self-directed 401k where you can invest it in the strategies that you want to invest in, but you can then do your own company matching contributions and things like that to really front load and get as much capital inside your 401k plan as possible. And then, of course, doing strategies inside your 401k to then compound the growth. Not the stocks and bonds and mutual fund type stuff that you typically invest in, but you can invest in real estate, in notes, in other projects out there, in businesses that you can actually invest and get that, compounding effect and take complete control of your own 401k plan that with utilizing this strategy. And you can utilize this in multiple ways. You can do self-directed IRA investing as well and contribute to your IRA on an annual basis. You can contribute to a health savings account and get the same types of deductions that you get from a 401k contribution or an IRA contribution as well, and then self-direct that account too. I have a self-directed health savings account, a self-directed IRA, and a self-directed 401k, all producing income where I actually control that money and can actually never pay tax on that, or have deferred taxes, never pay tax if it's a Roth, or defer taxes if it's a traditional retirement vehicle. So you can also do different pension plans and strategies to get hundreds of thousands of dollars inside your retirement vehicles on an annual basis to mitigate those taxes. So big strategy there to utilize. Don't forget about the health savings account and the company sharing contributions there for your 401ks. Really big items to, kind of focus on. Also, of course, paying your kids in different ways, right? If they're working for you and they're actually doing activities for your business to be able to help you, you got to be careful and not do it too young, or has to be justifiable as far as an expense goes, and you have to be able to back that up in the eyes of the IRS. But if you pay your kids, you can not only pay them for their active work, but you get that deduction on your side, but you can pay them extra and be able to contribute that to a 401k plan or an IRA for your kid as well, so that they can start to build their own retirement to where they'll have more money in their 401k plan by the time they're 18 years old than most people out there, than most different private investors or the population out there. So if you can set up your kids this way, not only can you take the deduction every year, but you can set this up so they can contribute those active earnings to their own retirement vehicles and pay no tax on it and build their own long-term retirement vehicles that way. So great strategies to use. Now there's some, also you want to be able to make sure that you're paying them for the expenses involved in their life, right? Non-deductible expenses to you, but you can pay them and they can pay their own expenses, and then you can help them budget for those expenses and be able to show them the strategies that you can use and they can use in the future to budget for their own personal expenses and mitigate taxes, so it gets in their head consistently. If you're a parent, this is in my mind all the time, of course, as a parent. So really important strategy to teach your kids and other, youth in your life, right? So in addition to that, okay, so there's some strategies now to get rid of capital gains too. So there is what's traditionally the 1031 exchange, where you can take your gains on the sale of an asset. They have to be sent to a custodian that's going to hold those funds. If you touch the funds, you no longer can do your 1031 exchange. So have it sent to a specific custodian that can hold your funds, and then you find a replacement asset, and you have to find a replacement asset that hits your sales price, hits your down payment requirements for what cash you would get for that down payment, and then also hit your loan requirements as well, to make sure that you're hitting all the different facets of the 1031 exchange. There's some intricate details, of course, with that, but a great way to defer your long-term capital gains, and you can do this every single time you sell assets and rebuy something else and reposition your equity there, for these types of assets. So really key strategies to use. You can also do an installment sale, where nowadays, with the interest rates higher on mortgages, you can actually go through and sell your property with seller financing, and you're only taxed on the portion of the cash you get down as your down payment. So if you go through and seller finance that property, you can claim the gain over a long period of time as you collect the gain in monthly payments. So you're going to compute that every single year, pay a smaller amount on that big gain every year to spread out that massive, capital gain that you might have. And now you're going to be able to reduce, the tax bracket that you're in future years and in the current year by deferring those taxes long term if you're doing seller financing. So it makes a lot of sense now to do seller financing in this kind of environment, when interest rates on mortgages are 8% plus, and you might have some gains built into that. Now you can turn that into a positive cash flow note as well, that note can be freely transferred as well, and sell that note. Keep in mind, the installment sale won't work. Once you sell that note off, you will be collecting all of your gains and pay tax on those gains right away. Okay, so there's also some good strategies you can use by shifting expenses and income from one year to another. Plan on selling that large capital gain property in a specific year that you might have bigger tax deductions, or maybe you want to shift it to the next year so you can plan more for the rest of the year to try to find additional tax deductions to offset that large capital gain that you may have. So doing income and expense shifting, where you buy that big expenditure maybe in the current year to get a current big tax deduction before year end, so that you can do that as well. And you want to invest in the right way to get those types of deductions too, of course. So being able to shift income into rental income and away from interest income or other ordinary income can be really valuable from a passive income perspective, because there's strategies you can use, like I mentioned at the beginning of this video, that you can wipe out all of your rental income every single year. And that strategy is actually doing cost segregation studies and buying new property every year, so that every single year you can front load the tax benefits on those cost segregation studies and take them, those losses, against your passive gains from your rental income to wipe them out every single year. So great strategy to use. There are some intricacies there. So what is this cost segregation deduction, this mysterious deduction? All you're really doing is you're taking the building that you're buying. So you buy a $100,000 building and you are splitting it up into land and building, right? So the building portion is typically deductible, and you can normally write that off on a single family home over 27 and a half years. But as part of that building, what is that building made up of? It's made up of windows and fixtures and appliances and all different types, of fixtures and furniture and costs that go into that, right? Electrical, plumbing, your fencing, your flooring, all of those things have secondary costs or costs associated with those. So you can actually go through and pick apart your property, and you pay an engineer or a cost segregation study company to come out and analyze your property for a fee, and then they break it apart into a bunch of little pieces. What happens is you're turning that into 5-year property, all those furniture and fixtures and appliances, 5-year property and 7-year property and 15-year property, instead of 27.5-year depreciable property. So instead of writing it off over 27.5 years, you get to write it off over 5 years, 7 years, or 15 years, depending on the category. The good thing, though, is that there's what's called bonus depreciation, where you can front load that 5-year, that 7-year, that 15-year property into year one and get big, giant tax deductions in the first year you buy an asset. So every single year, you should be saving up your money, buying a new property, putting 25% down, buying a new asset, getting financing in place to really take advantage of those as long as it's positive cash flow every single month, and then redoing this deduction every year so that your rental income gets completely wiped out every year that you buy a new asset. Yes, it grows, but you're able to wipe it out every year by doing a new investment like this. You can do this by buying property in your own name. You can also do this by buying and investing in syndication investments run by other operators like mobile home parks, self-storage, multifamily, or other funds or property funds out there that are available to invest in, where they front load those tax benefits many times and do those cost segregation studies, consistently through those projects. So I like to invest those chunks of money because I don't have to do the financing aspect and get the new loan. I don't have to do all the operations work. I can diversify and put smaller chunks of money into multiple operations in different markets around the country, different asset classes and different operators, so that I can diversify. I also buy direct assets myself too, and buy single families and multifamily buildings myself to front load those tax benefits for ourselves as well. So, and in addition to that, if you buy a renovation project, you do the cost segregation study first before you do the renovation. So you write off a bunch of those items, and then you can go and break down the renovation as well and write off a lot of those little intricate costs of the renovation and change the form of that from building into those furniture and fixtures that can be written off and front loaded via bonus depreciation on the renovation too. So you get the most bang for your buck on those renovation assets, where you can not only do the front load depreciation on the building, but the rehab as well. And if you do this every single year, you will not pay tax on any of your rental income or your passive other income every year. So great strategy to use to really front load that and try to invest in ways that will provide more rental income versus interest income or capital gains income or ordinary income. If you focus on shifting your income and set up your entities and structures to where you are able to get more rental income versus other types of income, you will be able to mitigate even more of your taxes. So I hope this helped you guys. If you guys want to learn more, you can go to MathewOwens.com, MATHEW Owens.com. I have multiple master classes for you on there on different strategies to invest in real estate, different property analysis sheets, due diligence checklists, all types of resources that you can use to help you become a better investor. Hope this helps, and I will talk with you soon. Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. 3 of the key pillars to becoming a successful real estate investor. Number 2, you can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number 3, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.